Hi there. Thanks for tuning in. Today we're going to be doing an analysis and valuation of Geopark. What are they doing? So, the business is a business that drills, develops, and produces oil and gas. They're an oil company. So, they get licenses, they acquire assets. So, they will actually have a little bit of debt, a little bit of cash used to acquire the infrastructure that's already there. They look at the potential of acquisition of strategic assets, and they do that in order to, in the long term, drill, develop those oil fields. They operate mainly in Latin America, so Colombia, Ecuador, Brazil, Chile, and Argentina. So, the overview here, these are all the countries that they operate in. They basically have a drilling success rate of 81%, they say. Their daily production is going up and up and up, especially in Colombia, but also in other countries. So, yeah, it seems like a company that is growing, that has a decent picture, and has its fingers in a lot of pies in Latin America. And it's a low cost operator. 90% of production is cash flow positive at $20 to $30 the Brent barrel. Right now, Brent is at what, like $70? So generally, they operate pretty efficiently. They'll still make money no matter whether or not the barrel of oil goes lower or higher at the end of the day. So we like companies like that. When you are investing in an associated commodity that's related to a company, then you want to find those who can produce at very, very low cost. Okay? So low cost and profitable operator, as we've been talking about, generally they have Brent, they can sell at $65 a barrel. Their operating cash flow, their capex, and their debt service, that all makes up for it. They do have a great shareholder return with dividends. They acquire stuff in Argentina, and then their operating costs have been going down, down, down. Right now, they've been going back up again. They say that it's because of the impact of El Nino. You would hope that in future results and annual reports, they can bring it back down to this $7 per barrel. And in general, everything has been reducing, so they have great cost per barrel overall. And this is great. We want to invest in businesses that can just operate at that low cost. They're free cash flow positive, which is great. So despite all the capex, all the taxes that they take out here, and the debt service payments and everything, free cash flow is very positive. And then even though they have some debt, they are estimating like a nice amount of cash flow from Argentina and from their new asset that was acquired there. Now, their balance sheet is great. They have pretty much after everything comes out, cash that is pretty equivalent to before, and it's a healthy chunk of cash. It makes them flexible, of course. It helps them pay whatever they may need. It is after issuing dividends, after issuing buybacks, and all this stuff. So it looks pretty healthy. And overall, their leverage ratio is going way down. We want the leverage ratio that is generally below 3. Why? Because in the event of liquidation, first, a lot of people get paid, and then lastly, the shareholder. So we want a low leverage ratio because in the event that this gets liquidated, we want to get a payout as investors. So this is fantastic. Now, the overall financial picture, if we look at the last 10 years, well, you do see some cyclicality with oil, don't you? Where you'll see double digit growth and then contraction in the double digits sometimes, and then stratospheric growth here. Look at how in 2017 and 18 they grew 70% and 80%. This is also related to acquisitions. That's why they do these strategic acquisitions. You see negative years in 2020, 2021, and 2022 with stratospheric growth, which makes sense. This is when inflation came about as well. And then 2023 with a little contraction. In general, they have their cycles, and you will see in the stock price that they do too. But look at the margins here. In the gross margin, they managed to just grow this, and then it stayed high. In a year where they contracted 27% in the revenues, the gross margins still stay above 50%. Same with the operating margins. They're pretty high and they're above 40%. So we like to see that. Why? Because if you can keep your margins very nice when you are contracting, then hopefully that can carry over to when you grow again. Okay. So and here with the return on assets, return on equity, return on invested capital, it's still looking okay. Even in a year where it contracts, it's looking okay. It's not negative like in 2020, for example, or in 2016 and 17. So, okay, maybe it's a company that sees cyclicality but does get stronger through these cycles, right? In general, the highs are higher and the lows are lower, and that's what you like to see with a company like this. They also return plenty of value to shareholders. I mean, they've been outperforming the price of Brent crude for 10 years, really. And so this is wonderful. They also give you this net asset value per share valuation. So they're showing you, hey, it's pretty good in this way. They're also trading below historical multiples in terms of EV to EBITDA, which is what I look at sometimes. When you can't value something through free cash flow, for example, I like to look at EV to EBITDA. And generally, they are trading below their historical multiple. So it's kind of cool that they're actually including this right here in the presentation. I mean, it shows that they do care about valuation and they do care about value, what the value represents. And how do they give you that value back? Through quarterly cash dividends or share buybacks. They have a dividend yield of about 7%. It's a little less now. And then they buy back a ton of shares. So that's fantastic. And they also seem to have pretty okay capital allocation. So in general, the capex you can use this to predict, but here you can see about how flexible they are depending on the Brent barrel. So here they're going to have the cost or what they make out of a barrel of oil is the base case is 150 to 200. If Brent is 80 to $90 per barrel, below 70, 100 to 150, and above 90, 200 to 250. That's wonderful, right? That's wonderful numbers, especially knowing that, well, some forecasts have rents going up actually, or staying the same. So this is wonderful, actually. Here, we're going to do a discounted cash flow model. I'm not going to give them much growth in these coming years. So this is to just account for volatility, really. So I'm going to say that the free cash flow per year stays very close to the $105 million a year level. And then I have a required rate of return of 12.5%. Usually I'm 11%. I added that extra 1.5% as part of country and geopolitical risk. When you're investing in places like Latin America, you have a little bit of geopolitical risk here and there. So a way to do that is either to add a margin of safety or to increase your required rate of return to sort of show for that. Then my perpetual growth rate is about 2%. I'm going to say that they're going to grow that in perpetuity, basically divided by the total amount of shares, and then the fair value I get for it is $18.89. However, if you subtract the net debt that they have, the value post debt is $11.05. Now, this value is about spot on, actually. It's pretty close to what it is. So, as you see, $500 million market cap. I mean, it's not a huge company. P ratio of 5, although P ratio is very deceiving with oil because it can easily shoot up to 30 or shoot down to 1, depending on the price of the barrel and whatnot. Dividend yield of 5.5% roughly. And as you'll see, this company has cyclicality. I mean, the best point to buy it objectively was here between 2015 and 2017 when everyone hated it, and then everyone loved it here, and then they hated it in 2020 when the barrel of oil went very low, and then they loved it again, and now it seems to be maybe in a recovery phase, maybe not. I mean, it's a company that if it dips way back down to this 7.5 level, for example, I would say scoop it up. It's kind of a no-brainer. And if it goes up to $20, I would say stay away. It's definitely not a no-brainer in that case. I would just the risk becomes higher than the reward. So as you see, there are times to buy this, there are times to sell this, there are the cycles, and the best time to buy is at the bottom of the cycle when everyone hates oil, you know? So there's solid fundamentals here. There's a good dividend and many share buybacks, which means that you as the investor get plenty of value in return for investing. And I have a conservative free cash flow valuation, which with very little growth, and yet the overall picture seems pretty neutral, which means that any overperformance of this, be it in the price of the Brent or just them being very efficient, can give great rewards. So at the end of the day, their performance will depend on the price of oil and their ability to keep those costs lower than the price of the barrel. However, if you do believe that oil will increase in price or be more important in the next couple of years, well, this could be a particularly great opportunity. Or if you see this dip below that logical amount where you would be like, I have to buy this because eventually when this cycle flips, it's going to be a great opportunity. So at the end of the day, lower costs and increased earnings. I mean, the joke is that people hire consultants to just tell you lower your costs, increase your earnings, and then they drive away in their Maserati. But it's kind of true. I mean, in general, when you are looking at commodity companies, you're looking at those who can produce with the lowest cost and increase their earnings consistently when the cycle is doing well for them. If they're hitting those higher highs and lower lows throughout the cycles, then you know you have potential. I hope this helped. I hope you learned a lot. I sure did, and it was very fun to analyze this company. If you want me to analyze different companies, please comment down below. Thank you so much, and have a great rest of your day.